guys, welcome back to the Capital Mindset Show. Before we begin today, I want to make a quick announcement or a quick, just statement. So I just did the video regarding the interview, right? Where a subscriber came on the show and was able to interview me. Based on the reception, everyone seemed to have liked it. So I will be doing more of those in the future. Okay, so I will have a system for how I will bring people on, but as time allows it, I'm going to continue to do that here and there. Okay, so I just want to make that quick announcement. All right, and then before we begin today, I also want to say, watch this video if you guys are curious. I just say that please be a little bit open-minded about it. I know that this topic is very contentious, and you might think that other YouTubers have covered it to the same extent in the past. I have a huge catalog of videos covering this topic. I just have been avoiding making new videos on this topic more recently because it is easy to kick stocks when they're down. It is much harder to kick them when they're up. Okay, so this will be the last video in this time frame that I'm going to make, and for a couple of reasons. One, I don't want to emotionally affect the decisions of investors. I think that investors should, decide if they want to sell a stock, they should decide that on their own and not, get a lot of input of fear. It should be for the right reasons, right? We need to do things for the right reasons, not necessarily the wrong reasons. So I'm going to kind of avoid that. And I also want to just say that if this recovers in the future, or these entities recover in the future, which I still do believe, because I do believe that the sentiment will change, and we'll get to that. We'll get to the whole sentiment driven thing later on in this video. But then I will, turn this content back on. Essentially, I will start making this content again, kind of getting the information out there. Again, the goal of these videos is just to get the information out there. You guys can listen to it, digest it, decide for yourselves whether or not it's accurate, it's not a concern to you or anything like that. But I will be making several key points, but I do hope you guys enjoy this video. Okay, so before we begin, or now we're beginning actually, I want to give a brief overview for those of you who don't know. We're talking about Chinese VIEs, right? And we've covered on this channel several times different VIEs, American VIEs, British VIEs. So the difference is, or VIE is just an umbrella term. So I want you guys to dispel this notion that VIE is simply associated with Chinese companies. It is in the modern sense. A lot of people, when you kind of say the word VIE, most people start to think Chinese VIEs, but in reality, it's just an umbrella term for a array of a structure that an entity chooses to adopt for various reasons. Now, typically a VIE is designed first and foremost to protect the business from the shareholder. Interesting enough. Okay, so right off the bat, I look at VIEs skeptically, even if they're American, British, whatever the fact, but not all of them are created equal. That's why we have to look at them with an individual perspective, right? We can't just do broad brushstrokes. But however, I'd like to say American and British VIEs are quite different from what I've been seeing in the Chinese variants. So the Chinese variants are literally quite different. And I'll actually get to that, why I personally think, and I'll make the case for it, why they are not, and they're not the typical kind of asset at all, if you can even call it an asset. So we'll get to that in a second. And there will be new information that I haven't talked about in any of the previous Chinese videos, and it's regarding taxation and all that, not with your individual taxation. It's more of the complexities of taxation as the money is moving around. Okay, but we'll get to that. I'm excited for that one. We'll be using a real world example. I mean, not necessarily a real world example, but I'll be using, a live example. That's the better, more accurate way of saying it. So I also will be using Alibaba as an example or a flag post, so to speak, because that is the most popular one. For some reason it is. I think it's the Amazon effect. So we'll be talking about Alibaba. The Tencent is technically the largest company in China that's publicly traded. But people like to talk about Alibaba more, and because there's Munger involved and Monish, and I'll address those investors in a second when we get to some of the frameworks of the West and how they look at VIEs or Chinese stocks, right? So the first thing I kind of want to go over, and this is again for those of you who have not seen this yet before, and I want to kind of bring you guys up to speed. All right, so this is a VIE structure, and this is, I'll try to break it down as simply as possible, but this is a skeleton structure. When I say skeleton structure, I think you think of the word skeleton key, like it's not necessarily the exact key, but it kind of just works for the most part of explaining all of these, right? So you are the foreign investor, and then you are buying actually the SPV1. So when I say the word SPV1, you think Cayman Island company. SPV2 is Hong Kong. WFOE is onshore. And then that's another word I might use from here on out. Onshore and offshore. Onshore is companies within China or entities inside of China. Offshore is anything outside of China. We can dispute that Hong Kong is China, but they treat it differently. And actually that comes into the complexities of what Hong Kong is to China, which is really important. It's a very important strategic location for China in economic sense too. So the SPV1, that's what you're buying. And then you could buy the SPV2, but you're not escaping. And I got some questions in the comment section, but I have addressed this in previous videos. I'm just addressing it. I'm trying to address everything in this video, okay? But the SPV2 is still part of the VIE structure. I actually saw, one of you sent me an interesting video that someone seemed to have, I watched some of it, but this individual was seeming to quote some of the points I made in previous videos, but actually misquoted them entirely and said some incorrect things. So yeah, if you buy the SPV2, shares, that's still in the VIE structure. You're not actually owning the shares. All right. So what's this PRC individual? Well, someone actually owns the shares at the end of the day. And then you have a contractual agreement. So this is very important to note because this is going to come back later. You have a contractual agreement with the PRC individual. So let's say I own shares of Alibaba and I'm the PRC individual. So I'm a citizen of China, et cetera, blah, blah, blah. I actually own the shares. Right. So I create a contractual agreement with the WFOE, which is the entity inside of China that's separate from business. It's another entity. And then I make a contractual agreement that says it's like a loan, so to speak. It can vary in terms of the lingo of the contract, but the point is it's a contract. Right. And so right then and there, we are entering a different aspect of valuation and asset class. It's a contract, it's a contractual arrangement. Right. This is extremely important for a later point, okay? But I make a contractual arrangement with the WFOE that I'm going to share the profits or give the profits because technically I'm saying that you are owed these profits, okay? Or the WFOE is. And then the WFOE is owned by the SPV2 and then the SPV1, and that's what you're buying. So the points I'll make here, and then we'll leave this example, is you're going to face many different jurisdictions. I also want to note that when I covered StoneCo, I said one of the main risks is that they're actually in the Cayman Islands. They say so in their public documents that is a potential risk for you as a shareholder, because if they were to do anything, there's very limited resources for you to come after them. You're basically just, you can get easily extracted of resources. Let's just say that. So the SPV1 being in the Cayman Islands is of no, it's not a minute detail. Okay. Right there. It's not a minute detail. Then the SPV2, again, if you avoid the SPV1, just go to SPV2, you haven't gotten out of the system. Okay. And then you can't get the WFOE and you obviously can't get the domestic company. That's not allowed. Okay. So why did the Chinese government do this? Well, they designated key businesses or key sectors. And we'll actually get back to this to the actual institution in China that actually did that. But they didn't want foreign influence or foreign ownership of these entities. However, obviously you want the money to build it up. So what's the best way of doing this? Well, if the Western world is captivated by your growth, why not just sell them on this idea and hope that, you know, a lot of people will give you capital for basically nothing in return, because that's essentially what they happen. Because let's actually go into the differences between a contract and assets, right? Ownership, property rights. So contracts are governed under contractual law, and then property is governed under property law. For those of you who are in law school or lawyers, you guys can probably comment down below and attest to this, but property law is more powerful, quote unquote, stronger than contractual law in terms of its enforcements. And this is like a global understanding, right? So contractual law, you know, this is a contract. It's already on a weaker footing, right? Now we add the jurisdictional risk, and then, okay, but we've got to understand that Chinese governments win 99% of all cases, right? They have a 99% conviction rate. So the ability for us to win in China is very limited. And I'll actually cover real world cases in a second or later in this video. So what are some issues here? Well, if it's a contract, I need stipulations. That's the importance of a contract. I have stipulations, right? A bond is a contract, for example. It's a debt. I owe, and I have stipulations on time period or time frame, and how much will be paid, right? What are the stipulations here? I'll let you guys pause the video and you can comment down below what you think the stipulations are, or just think to yourself, what are the stipulations, right? Is there a moment in time where something must occur in order to comply with the contract, or is the contract ambiguous? Is it the best of both worlds, right? Because when I buy common stock, I own the business. It doesn't have to give me anything now. I own the potential of the future of that business, right? But if I buy a contract, within that contract, it should state, you do X and Y by this time, and or maybe there's not a time, maybe it's a completion measure. So that's always stipulated in contracts, right? In this instance, there is none, right? That's the actual answer. There's no stipulation of time frame. There's no stipulation of amount. So then, how do we evaluate a contract without these stipulations? It makes it an impossible game. So you bring this to me, like, let's say you say, Fabio, you got to analyze these contracts. I'll say to you, I can't give you a value. There's no way. So Chinese bonds, I can evaluate them. You just evaluate, the cash flows that they will generate over long periods of time, right? And you have stipulations on time, so you know exactly when they're supposed to pay. And then you can evaluate the risk of whether or not they will pay, right? That's doable. But you throw me this and you say, okay, here's a contract. I don't know when they're going to pay you. I don't know how much they're going to pay you. There's ambiguity. And then I'm just like, okay, I don't know how to evaluate that, right? That's its own thing. That's not a stock, and that's not a bond. What is that? And that's the answer is it's a Chinese VIE. It's a very unique instrument in the investing world. So, and that's why I keep saying the word Chinese VIE, right? Again, if we go to rocket companies, there is a value to rocket companies. It is a VIE. Dutch Bros, that's a VIE. There's a value there. Interactive brokers, that's a VIE. There's a value there, right? Because at the end of the day, there is an ownership within that, okay? In this, there is quite literally no ownership whatsoever. And then I'll actually when I get to the taxes, it's going to be very important. But I want to use Alibaba again as the example, and we'll actually take a look at the price action that we'll kind of quickly discuss, because I want to actually say this here and now. I don't think the price action recently has anything to do with the quote unquote VIE problem that I'm stating. It has nothing to do with that. If it was, this would be getting close to zero. However, it is heavily driven by sentiment. And remember, I do own it in the portfolio. There were two reasons. One, I still do believe that there is a speculation on my part that the Chinese government wants the party to continue, and they're going to improve sentiment. And that goes into why I think this is happening. This is entirely sentiment driven, right? This is the potential of conflict, potential of blah, 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 blah. Okay. Delisting, I'll discuss that here. So the delisting risk, I don't really care about that. That's not really, that's like the tip of the iceberg in terms of what the problems are. So the delisting risk, the only risk I see of delisting is coming from the United States, right? If the West smartens up to this and says, hey, you can't do that, then they delist them. That's the delisting risk. I don't think China has any motivation to delist this unless push comes to shove, which we'll get to that in court cases. Okay, when push comes to shove, oh yeah, they do it. But when they want to just extract and they're just you're kind of like lulled into it, they're not going to do anything. There's no reason, right? You're giving them money and they're just giving you nothing in return, and they've gotten away with it so many times in the past. Now, in this instance, for example, these larger entities. It almost comes like a bargaining chip for China, because China's like, we've already ruled these illegal. It's already like illegal technically. So, and I'll get to that when we get to the court cases again. I keep referencing that because I'm excited to get there, but they've already ruled it illegal. So at any point, they technically, in all fairness, can invalidate them. At any point, they don't want to, and there's no reason to. And I hope that kind of makes sense now. There is literally no reason to invalidate them because your companies are extracting capital from the West and giving nothing in return. So if we think of it in that sense, right? Why would they do it? But the whole issue with China, or the quote unquote risks, right? In terms of delisting, people are thinking about the United States, right? And then they say, okay, you just buy the Hong Kong. Well, okay, congratulations, you're still in the VIE. You're not actually avoiding the biggest risk of all. But yeah, we'll get to that. So again, I think all this is driven by sentiment, and the Chinese government might want to fix that sentiment in the future. There's a political event happening, I think this year or next year. It's decently important that Xi Jinping looks good for his people and for his, well, I say his people is like his council, the CCP. So just having my morning coffee, guys. So yeah, it's down. Well, let's see, from all the time highs, 75%. I mean, again, it's easy to talk about it while it's down. This is why this is the last video on this. And I'll just reference this video. I won't make another video until, let's say, if it goes up. If it goes to zero, you know, this is the last video I'll make. But I don't think it will. All right, so I think from here, let's actually go into the taxation. I think that's going to be interesting to note. So I have for us here a example that we're going to use, and I'm going to, you know, make up a number, right? So up here, I'm going to put, let's say, I don't know, whatever this is, $100 million. All right, so $100 million, I was going to think a billion, but whatever, 100 million works. So we have all these taxes. So we have the value added tax, the income tax, the corporate tax, the withholding tax. Okay. And by the end, this is something new that I'm covering. I haven't covered this before, but in summary, what we have to do essentially is take the fundamentals that we're reporting on the business and actually convert them a little bit differently, because you are not the shareholder, you are a VIE holder. So you have to actually go through all these taxes. For those of you who like to look at taxes, here you go. This is not your individual tax rate. This has nothing to do with that. This is actually everything to do with the movement of money. And I'll actually quote different sources as to what this is. But basically, for the most part, a lot of these companies or these VIEs, they state this in their filings, that this is a ambiguity, right? Because some of them predict this. Some of them, like, as in they calculate it, others don't calculate it. So a lot of people don't really see this. And one problem with this is, at the end of the day, the value of any business is the cash flows that can return to you. That includes taxes. Taxes is a cash negative. You have to remove that. You can't touch that money. So the money that you can touch, for example, in this example, this is profit right before the taxes of the business, right, in China. So this, for example, this is Alibaba's profit, right, after everything. And then you have the value added tax that goes to the individual, right, who's the one you have the contract with. Then they have the income tax, they remove 20%. Then they have the corporate tax, because now it goes to the WFOE. Very important. It goes to the WFOE, which is another entity. And then that gets the corporate tax. And then when the WFOE wants to give it to the foreign entities, then you have a withholding tax of 10%. So after all those taxes are taken into consideration, you are estimated around that, about 50.32% down from the actual profit. So when we look at a valuation of Alibaba, or any VIE for that matter, we have to evaluate it based off the cash flows that we will touch, right? So it's a little harder, because, like, if I look at a American business, right, and I'm in the American jurisdiction, or like the money will settle in an American jurisdiction. Same with a European company. If a European settles in the European jurisdiction, we can remove the withholding tax and all that stuff. So we just have to focus on the corporate tax that the company already paid and it's already should be calculated in our valuation assumptions. Then the only thing we have to worry about individually is our individual taxes. So in our evaluation methods, we don't include that, right? Because that varies, et cetera, blah, 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 blah. So in our evaluation methods, we don't include any of that. However, in this instance, we have to. We actually do, because at the end of the day, that's the cash flow that I'm going to touch is this one down here, right? And I'll highlight that for those of you who can't see, but I'll highlight from 100 million, we went to an estimated of $49.6 million. We're about half down. So you take the fundamental cash flows you think that are there, and you cut them in half, and that's even what you'd be able to touch, right? Okay, so some entities, by the way, don't even talk about this. They just say it's too complicated for us to calculate, so we're not even going to calculate it. But they do cite it as a reason why they won't return capital to shareholders. A very convenient excuse, and you know, if true, actually kind of makes sense, right? Why the heck would that be a rational thing to do in the form of buybacks or dividends? Because the buybacks aren't done in the actual entity level. We'll get to that, but or maybe not get to that. That's basically it. It's that simple. But the cash flows there, right? They say, okay, we don't really understand the technicalities of it. We have estimates. Some of them again don't. But then we're going to say, yeah, that's why we're not going to give you any cash. We're not going to, provide any cash back to the shareholders, right? It'll always be a net negative cash inflow, right? So cash will flow into the company from the investors, but not out to the investors, right? And then that's the crux of the argument, guys. All right. So, but even then, when you have to do your evaluation, you do have to consider this stuff. All right. And then, so I'm going to actually start, I'll read a quote here. This is from the Council for Institutional Investors, right? Although it is difficult to follow the actual cash flow of companies using VIEs, the payments stipulated under the contractual arrangements between entities could incur the taxations outlined. Most listcos indirectly confirm the potential for this panoply of taxes in the SEC filings, citing that corporate tax as a reason not to extract earnings from the VIE and the withholding tax as a reason not to pay dividends. While some companies provide a precise estimate of their deferred tax liability, even if hypothetical, many more avoid providing such figures by claiming the calculation is impracticable, citing a reinvestment exemption, or suggesting that the existence of tax-free means of moving their money. The result of these divergent approaches, as some companies account for deferred tax liabilities and others grasp for any reason to avoid them, is inconsistent financial reporting across companies with VIEs to the confusion of investors. And again, that's from the Council of Institutional Investors. So what they're basically saying, in summary, is that the taxes are there. A lot of companies talk about it. A lot of companies don't talk about it. But when they do talk about it, they also say, well, that's why we're not going to, give cash back to you guys, right? So if you're wondering, right, that's why. That's interesting right there. So now I'm going to go over some court cases because this is what I've been hinting at, and I've mentioned this already in previous videos. Again, that's in the playlist, which actually I need to mention or show you guys the playlist. You guys can actually, I'll show it at the end of the video. I'll show the playlist at the end of the video. So before we begin, let me actually take us to, I'm just going to cite the court cases here. It's fine. All right. So in 2012, we have the Chinaman case. China Chem case. China Chem, sorry, not Chinaman, China Chem case. The Chinese Supreme Court invalidated the ownership claims of the outside investors and ruled that the contracts were unenforceable, right? This is in 2012, because the VIE-like structure amounted to concealing illegal intentions with a lawful form, cited Guo 2012. In the Giga Media case, the Shanghai arbitrator also reached a very similar conclusion, and this is cited in Gillis and Lowry 2014. All this information can be found in a very nice website called the China Law Blog. That is actually a site. Hopefully, you guys find it easy to navigate. I've heard differing opinions on how easy it is to navigate. All right. Now, I did say that there is a governmental institution that has already declared it to be kind of illegal, right? So they have that excuse there if they were able to do it. And I'm kind of showing here, when push comes to shove, basically when you shove the Chinese government, oh yeah, they're like, yep, it's invalidated, sucks to suck. Go bye. You wanted exposure to Chinese growth or whatever. So, for example, in the Ministry of Industry and Information Technology in 2009, they issued a prohibition of the use of the VIE structures by companies in the internet gaming sector. Right. So there you go. You got Tencent, you got a bunch of other companies right there. And then so the prohibition appears to be ignored largely. Right. And this is cited again in Gillis 2012. And then Buddha Steel is another example. Buddha Steel was forced to withdraw in 2011. The government just literally said invalidate for whatever reason, because they've already ruled in themselves. They've already declared that it is illegal. So they actually have the legal power and the authority. Well, they have the legal power and authority to do whatever they want. Let me be clear, but they've already said that. So there's no complaint to be had, right? They said it's illegal. So we're just basically allowing these things because, again, it makes a lot of sense when you start to think about it. Why would they allow this? They declared it illegal, right? So it serves the purpose that at any point they could snuff it out if push comes to shove, but they get a lot of money in the meantime for giving nothing in return, right? And, there's more evidence that they're giving nothing in return. So I cited this before, but I want in previous videos, I think I've cited this like 3 or 4 times in 3 or 4 different videos, but look at Alibaba and Yahoo and Softbank, right? These are 2 big companies that owned, I think, almost over 50% of Alibaba. And Reuters wrote an article back in the day, I think it was like in 2012 or something like that, where the journalist was surprised. They were like, wow, they own so much of the business, and yet the rug was pulled under them. They seem to have no control, right? And I'll try to say both sides. Alibaba said that Yahoo and SoftBank agreed to it, right? That was the claims before they settled, and I'll explain the settlement and what that meant. But before it all ended, they said, no, they agreed to it. And then Yahoo and SoftBank were like, no, we didn't. We did not agree to it. I'll let you guys decide who is lying in that scenario. And then think about the implications of that. Would you accept Amazon to lie like that? If your conclusion is Alibaba is the liar in that instance, would you accept that form of lying? And would you accept, for example, Jeff Bezos taking away Amazon Web Services and saying, yeah, I'll give you pennies on the dollar? Would that be an investable business for you going forward into the future? The fact that happened, all right? So that's something that quite literally happened with Ant Financial. Jack Ma was like, yep, this is now separate. Okay, now we'll get into the settlement, because you'll probably say, well, they settled. Well, they settled for pennies on the dollar. And think of it like this. Yahoo, so much of their balance sheet, this is a very important point, so much of their balance sheet was allocated to Alibaba that should have they fought, right? And, had the guts to fight that, the write-offs would have been incredible. And think about all the implications. You're the CEO of Yahoo Finance. The rug was pulled under you. You have a couple choices ahead of you. You could fight this, which you're going to kind of fight it, right? But remember, China in this instance wants to keep the allure, right, of investing and providing and buying these VIEs. They don't want to outright say, you don't own anything and we can do whatever we want. They want to kind of just coddle you. I use the word, they coddle you, right? They hold you, they rock you back and forth. They say everything's going to be okay. Shh, little investor, it's going to be okay. So they want that. And so what they do is a settlement, right? They know that Yahoo can't really fight this, because if that would mean the destruction of their business domestically, right? Their credit would go to the gutter. All of a sudden, a bunch of their assets on the books are going to be worth nearly zero. And SoftBank's in the same position too. So the Chinese government can say, okay, we're not going to give you the value of it, but we're going to give you a little bit of money and you're going to take it and you're going to like it, right? And so that's exactly what Yahoo and SoftBank did. They took it and they liked it, okay? Because there's nothing else they really could do, right? Faced with Goliath in this instance, the Chinese government, there's nothing they could do, right? So that we get to the point as to why we settle. But remember, these are large companies, right? They got the rug pulled under them. What makes you think, for example, it wouldn't happen to retail investors, right? And remember, China's goal is to one day surpass the United States. Let's say that happens. Let's say China is now the world's dominant superpower. The United States has entered its decline phase. Let's say United States in comparison to China is like the UK, right? After the empire and stuff like that. Do we really think that China couldn't just pull the rug under the entirety of the United States and be okay? Yeah, it probably could. It might hurt like a little bit, but they're already, if we're talking about they have replaced the United States completely and they dominate completely, that is a viable option, right? Because at the end of the day, they never ever gave you anything, right? Again, there are some companies, I want to actually say this before I forget to mention this. There are some companies that are not VIEs that come out of China, and there are assets in China that are not these weird structures that actually have value. I've already stated Chinese bonds. Chinese bonds have value. They have stipulations. It's a contract with the stipulation, my friends. If you have a contract with no stipulations, how the heck do you evaluate? I want you guys to comment that down below. How do you evaluate that? There's some sort of like disconnect going on when we say, okay, the value of anything is the present value of future cash flows, blah, 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 blah. Okay, well, okay, an asset, you own those cash flows, and a contract, you don't own the cash flows, but you have stipulations on when you receive cash flows, timeframes, and all that, blah, blah, blah. So you can evaluate it, right? Even common stock, there's no time stipulations, but the ownership makes up for that, and you own the potential, and you have control over it. Okay, very important. So that's kind of more or less the crux of many of the arguments. I've seen some YouTubers talk about some of these issues, but not all of these issues. I think you have to take all these issues into account and then get I guess the bigger picture, or hopefully I'm doing a better job than previously at providing this bigger picture, because, you know, as I'm making more and more videos, hopefully my skills are improving in terms of explaining things via video format, and I can keep myself a little bit more structured, right? Less rambling, so to speak. So we'll get to the valuation of Alibaba and use that as kind of like a case study for those of you who are just curious. But I'll close off some thoughts about the VIE. So the VIE, or the Chinese VIEs, right? Because very specific. I want to actually, yeah, I'll close off with this one, and then we'll get to the valuation. Charlie Munger and Monish, very famous investors, very proven investors. They're very bullish on Chinese companies, right? Well, here's my issue. I think that what they're doing is they're using a formula or a method that works everywhere in the world, quite literally everywhere in the world. And then they're applying that same formula to something that is quite literally its own thing. Maybe in the future, if things turn out the way I think they might turn out, you know, hypothetically, we'll all look back and say, obviously, right? Obviously, that was the case. Obviously, it didn't turn out well because we didn't own anything. And we're going to call it like its own different asset, right? It's not even an asset, but we're going to call it its own different thing. We're going to look back and say its own different thing. Or I'm completely wrong, and Chinese are very nice people, as they've proven to be. They've proven that they're very nice individuals, very compliant, you know, not nefarious in any capacity whatsoever. So then, you know, they're going to coddle you. Those coddles are not just empty promises. They're going to mother you to death, and you're going to be very happy. So that's the two scenarios, right? I see before us. Well, Charlie Munger, again, and Monish, they're applying what I call Western normative narratives that, you know, it's fair to say, I've had this criticism that, oh, you don't understand. China is a different culture. You have to look at it differently. I would say to that argument, I am the one looking at it differently. I am saying that an apple is not a banana. That's what I'm saying. This apple is not this banana. What the person is saying when they are applying the same framework, the same structure to, you know, everywhere in the world, and they're applying it to China, what they're saying is this apple is the same as this banana, because this banana grows on this really tall tree, and the tree is only growing. So I want to make sure that I have participation in that banana tree. Okay. And then I'm here saying, hey, but like you're looking at it as if it's this apple. And, you know, you have all these apples here, but you want to go get these bananas, right? I hope that's a comedic example. So, but you kind of get what I'm saying. It's comparing. The real example is apples and oranges. That's the original analogy, but I'm using apples and bananas. And there's a reason why it's an innuendo. If you can get it, comment down below, because it's, you know, bananas. All right. Anyway, so, gosh, I can't. All right, I'll leave that in there. That's fine. All right, so let's go to the valuation. Let's finish on with that. But again, I hope I get that point across. What my opinion is that those great investors are applying the Western normative narrative to these businesses, and in doing so, I think they're making a fatal error, because my bedrock philosophy is if I can't own it, I don't care about it. Right? I think that's fundamental to investing. Fundamental, right? And I think Buffett said that, Howard Marks has said that, all the other super investors have said that. I think the only ones that are kind of just forgetting about that are just the ones investing in the Chinese VIEs in that sense. And again, if I'll tell you this, if Buffett tomorrow or any day, any point in the future, if he starts buying these VIEs, I'll completely say there's something I clearly do not understand. If he starts buying those, I'll see it, because it's not above him to buy foreign stocks. We saw him buy the Japanese companies. So it's not above him to say, oh, I don't want to buy foreign companies, right? He does say bet on America and all that jazz, but you know, if he tomorrow bought all these Chinese VIEs, because, oh my gosh, like, come on, we'll get to it right now. Let's just go check how cheap these things are, right? All right, so let's go to the model. Let's just shove in Baba. Like, we're going to see how cheap this thing is, right? There's no way he hasn't seen this and been like, oh, that's cheap, right? I doubt it. All right, let it load. Give it some time, guys. Just waking up. It's early in the morning. All right, so required rate of return. We can't assume zero growth. If we assume zero growth, we actually need a lower price. And I am actually showing some dilution. I want to say this right here. They are doing a token buyback. I've already discussed the token buyback. For those of you who don't know what I mean by token buyback, I echo Michael Burry's writings. back in the early 2000s, where he talked about to be careful how companies buy back shares. They may do what's called, well, I don't know if he used that term, but I'm calling it that, a token buyback, right? Where it appears as though, and by the way, so I'm saying American companies do this. Why is it so much above Chinese companies? But they do it in a different way because, again, they're a VIE. So the context is very different, okay, in this instance. So the token buyback, again, is to coddle the VIE holders, and make them feel like, oh, yeah, no, you're very important to me. Don't worry, you do own this company. Don't ignore the FUD. You own me. And then, continue that sentiment drive so that they can continue to raise capital. And if you think about it, this negative 2% was actually off of a base of a higher market cap. We're at a lower market cap than it's ever been in terms of since its IPO. Okay. So this negative 2% is, in terms of the share count, was actually on a higher market cap. So they were raising tons of cash, absolute tons of cash. And it was amazing for them. I mean, oh, come on. You tell me that if you had a business, you wouldn't want to raise capital for free, just like literally someone just gives you money. It's like, here you go, I'm giving you money. Go do what you want with it. You don't, in fact, this is basically, in an example, this is what we're doing. I start a business. You're going to give me $10,000 in cash. Okay. I'm going to give you a piece of paper. And I say, yeah, you own the profits or whatever. And then you say, when are you going to pay me back? Like, when am I going to receive something, right? Because it's a contract at the end of the day. It's not, I'm not actually giving you my shares, right? And I say, I don't know. We'll kind of find out. We'll see how it goes. And then you say, oh, okay. Well, how much are you going to pay me? And then I'll say to you, I don't know either. We'll see how that goes. And then you're like, okay, deal. Here's 10,000. Right. That's basically what we've done. Right. That's what these entities essentially are. So if you know what, maybe that's the ultimate grift. Maybe I should start the Capital Mindset VIE. Right. And I will allow everyone to think they're participating in the growth of whatever I choose to allocate it to. And then and then I'll make that arrangement and see how many people want to give me 10,000 or whatever amount of money, right? That will be the ultimate grift, right? Just creating a capital mindset, Chinese style VIE, right? Pretty funny stuff. Anyway, so I wasn't joking. It's all in good fun, guys, right? And by the way, I also want to state this. If you have a differing opinion, all welcome differing opinions. I'm not saying I'm the absolute truth in this matter. Obviously, I hope I addressed that. I think I said that in the beginning of the video. Disagreements are there. There's obviously different viewpoints. You can take this viewpoint, just hear out my points, and then kind of come to your conclusions at the end. That is, again, why I don't want to make another video about this until, something's happened, right? So until these have gone up or something like that. So yeah, we look at analysts, right? Analysts have it at a strong buy, price target of 256, implying a 243.78% upside, right? Right there, analysts, they're infallible. Buy it now, buy so much of this because you're going to make 243%, right? When the market is pricing something so cheap, you could have found the cheapest thing ever, right? You may have found it, right? But watch out, because the market's not that dumb. Okay. So I'm not a firm believer in efficient market hypothesis at all. I do think there are inefficiencies within the market that we as investors can exploit. However, when something is really cheap, there's always something wrong with it. Okay. There's something there, right? There's a risk. There's a big risk. And it's not the delisting, but I don't think it's delisting. By the way, I think the historical discount, I'm going to go check this out, or maybe I do, or maybe I don't. But I have a suspicion that a large part of the historical discount in the Chinese VIEs versus foreign counterparts has been because not necessarily governance or anything like that. Potentially, it's because the cash flows are a lot less, right? Because of those tax implications, right? So, for example, in this evaluation, I technically have to adjust these for the tax implications, but I'm not, right? I'm just too lazy. I'm just not doing it. But if we were to do that, just cut. It could vary in terms of what the reality of the tax situation is, but it definitely will be lower. 100% will be lower than the eventual amount that is owned by the VIE holders once it reaches the final entity, right? As if that would happen. But all right, so we see revenues are growing. What a fantastic business. Yes. Cash flows are growing. What a fantastic business. Yes. Shares outstanding. Ignore this. It wasn't even public then, so it's aggregating correctly. So it is consistently going up. You know, it's a net negative capital return, right? And that's probably going to continue going forward from here on out. So let's assume some growth rates. So I think on the high end, they can grow at like 30%. On the midterm, they can grow at like 20%. Middle, they can grow at like 15. Lower ends, they can grow at 10. And let's see if they can grow at like 5%. So they're already at a price where someone could assume a negative 2% dilution and a 10% growth rate, and it's a buy right now. What the heck? It's growing at on average about 50% per year. I mean, this thing looks dirt cheap, right? What's wrong with it? What is wrong with it, guys? There's nothing wrong with this at all. Totally nothing. And yeah, the answer is, I mean, look at this thing. You're getting Alibaba, the Amazon of China, for like 8 PE, a price to cash flow of 6.8, right? Again, my assumption is that I really do think this right here is mainly sentiment driven. It does not have anything to do with the risks I've been speaking about. All the risks, they don't really care about it too much. The market doesn't really care about it until one day it does. And that's always a rule in markets. There's risks that we can identify. The market won't care about it until one day it does. Until one day it's like, all this is happening. I think I made that point, right, with the liquidity crunch that we've been talking about for before, you know, people were talking about it. We're like saying, oh, the Fed's saying they're going to do this. And that, again, we get into like the whole Snyder debate, Jack Snyder, or not Jack Snyder, but just Snyder. I'll just say Snyder. My mind rambles sometimes and I mispronounce people's names, but you get into the whole Snyder debacle, Dr. Lazy Hunt and all that. And then you say, does the Fed really have power and all that? Blah, blah, blah. The point is, you know, at least psychology, they said they were going to do this in like November, right? Last year. And then the market's like, oh, I don't care about it. I don't care about it. I don't care about it. And then like January, everyone just starts losing their minds. That's what I made the meme video regarding The Office, because it was absolutely hilarious. Like the Fed was like, I'm doing this. And then everyone's like, no, doesn't matter at all. No. Like, yeah, no. And then you actually started to see the canaries in the coal mine, which again, we were talking about, that there were these hype stocks, right? That were kind of coming down. And those are always the canaries. And then all of a sudden the market just loses its mind in January and goes, they're raising rates. They announced it last November. And then, yeah. So this is, you know, it doesn't matter until it does, right? So right now it doesn't matter. Right now it's all sentiment like, oh, we're going to go to war, delisting, but so all that jazz, right? Because if you tell someone like really like they really understand, there's this difference between like, oh yeah, I don't own anything, and really understand like, oh, I don't own anything. Like those are two different thoughts, right? When the market experiences that thought, not good, right? Or you know, China is like very, very benevolent. They're going to be like, oh, well, all you VIE holders, I'm going to give you the real shares. You guys are all recognized as owners now. Let's all share in the wealth that I essentially extracted from you. So yeah, that's all I'll say with that. And ratios, let's take a look at ratios. So long-term debt ratio and all that ratios, all these ratios are fantastic. Just pause here. You can just look at them. They're really good as a business if you look at the fundamentals. And then looking at the DuPont analysis, we do see margins are coming down. That's a concern. I saw one YouTuber was talking about the margins are compressing, and that's why it's down. It's like, yeah, sure. Like, you know, macro environment in China is not too good right now. All right, cool, whatever. And by the way, China is very sensitive to oil, more sensitive than the United States. So, you know, just so you guys are aware, that is affecting the macro environment in China. So yeah, I'll add that. That could also be driving the sentiment around companies like this. Okay, but I mean, they're having like what you could say if you equate this to an actual asset, right? Which I don't think you should, but let's say you do. It's the equivalent of they're having their 2008 financial crisis in terms of how cheap this thing is, right? This is extremely cheap. There's no doubt about it. Looking at the fundamentals, I can't, it's very difficult to find something that's cheaper than this if you think, right, that the fundamentals even matter, right? Which I don't, right? I clearly don't. I hope that's my bias, and hopefully I'm getting that across. All right. So let's see what the sentiment is around this company. So we see average sentiment is close to 1. So it's actually not that bad. We have Twitter at a 0.8. Reddit's the most positive. StockTwits is negative. Yahoo Finance is very negative. So we have negativity coming from these two sites, right? StockTwits is interesting because that's, you know, like almost like a Twitter of stocks, just dedicated to stocks. That's how I think of Twitter. I'm sorry, StockTwits. And then Reddit, it's twits too. Reddit is, I guess, I don't know if that's from, you know, Wall Street Bets or anything like that, but like taking a look at this, why Alibaba sits in my too hard pile. Good on you, Guru Focus. That's probably a good idea. Alibaba's oversold 120 per ADR. Okay, seeking alpha. Let me actually see who wrote this. Who wrote this? I know some of them. Okay, no, I don't know this person. Yeah, sure. I mean, I think we kind of came to similar conclusions, but I think it's lacking a little bit of nuance there, but whatever. So we'll stop there. We'll come back here. All right, Alibaba keeps sinking towards 6-year low. Neo stock also dives Chinese ADRs. I don't think this is a nice way of calling that, right? The Chinese ADRs is a little bit misleading. They're not ADRs. They are ADRs, but they're not really ADRs, right? That's like, I don't know. That's like, I'm lacking an example. How about this? Here's a challenge to you guys who are a little bit more comedically creative. You know, try to make a joke out of that. I don't know, because that's like basically you're not saying the full story. Make like an ex-girlfriend joke or something. I don't know. All right, so Alibaba peace is more profitable than war, especially for Bob. Yeah, sure. That's what I've been saying. For example, with investing in, well, it's a very small investment in the Russian businesses. If you buy now, you're betting on peace, right? You don't want war. If you want war, your stock's gonna go. I mean, you could lose everything. They could, because politically they can do very drastic things, right? So buying, for example, Russian stocks, when I was buying Russian stocks, you're betting that peace will be returned to the land. Everything will be returned to somewhat semblance, which is a good thing for humanity. And yeah, buying Baba or buying a company that is in a country that you might be going to war with in some capacity, is you are betting on peace, right? So yeah, I agree with that. Shark Tank investors, Kevin Leary says, in route to Chinese tech stocks like Alibaba is a good buy. Okay, cool, Kevin. Why Alibaba and Neo are seeing high interest rates from retail investors today? Well, obviously because, you know, a lot of people talk about it and say like, yeah, it's a cheap stock. You know, we're all the next Warren Buffetts and we found the cheapest stock ever, right? I'll take that back. That's a little bit demeaning in that sense, but but I'm just trying to say with that in a sincere manner, if something is very cheap, usually there's a reason, right? Not always, but usually there is. So I always like to investigate further, not just only look at numbers. You got to be both analytical, which I said in the subscriber interview. You got to be analytical, and you also understand the underlying business, very detailed. All right, Alibaba stock is dipped 30%. Okay, so yeah, the point is you either have some people saying, you know, it's too difficult, blah, 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 and I guarantee most of their fears are delisting and all that stuff, which I don't think is a problem, right? I don't think that's a real problem. And then you have the others that are, you know, completely saying, yeah, just buy it. They're evaluating it based on, you know, normative metrics, you know, just simple metrics that you would evaluate any other asset, right? But however, again, I hope I've addressed this. I don't think, and hopefully I made the point clear, it is not a normal asset. It's not a contract and it's not a stock, right? I cannot tell you how difficult that would be to evaluate a contract with no time stipulations and no amounts told to me, right? And I hope, you know, I did the example, and let me know if you guys are willing to give me cash in return for, you know, the supposed owing you, like with a contract, and I'll give you no time stipulation and no amount stipulation, right? None of that, right? Let me know down below if you guys would be willing to do that. And then maybe I'll do the ultimate grift. I'll one up every single creator and just like grift with the capital mindset, Chinese style VIE. All right. I think that would be hilarious. All right. Obviously I'm joking. I would never do that. All right. So, all right. Anyways, on that note, guys, I hope you guys enjoyed the video. We had I was laughing at myself. Okay. So I don't know if it was funny to you guys, but I was laughing at myself. You guys enjoyed the video, go ahead and feel free to leave a like, comment down below any questions, concerns. Let me know if, you know, you agree, disagree, completely okay with disagreeing. For example, I go on a show, which if you're not subscribed, go subscribe to him, Strongman Personal Finance, Jay Nagy, Alex Valley Head Investing, Nate, no, sorry, Nathan, not Nate. Oh my gosh. And in that instance, those guys, they disagree with me. And I think in index investing with Cole, I don't want to put words in your mouth. I don't know if you're invested in Alibaba or not, but yeah. So again, just to repeat their names, Strongman Personal Finance, Nathan Roscoe, Jay Nagy, Alex Valuehead, and index investing with Cole. I go on a show with them. I think if not all of them own Alibaba. I think all of us own Alibaba because technically I own Alibaba, but again, I do own it for the reasons I stated. And, you know, we have differing viewpoints, and that's completely okay. And then that's what makes the market. So I'm just putting out this viewpoint. This viewpoint may be incorrect in your opinion. And then again, comment down below. I'm not trying to attack you or relish that your stock's down, by the way. I bought the stocks knowing that, in my opinion, I was buying essentially nothing, so that, you know, when the value goes down, I could have, you know, done whatever that money, you know, I could have just enjoyed that money, went out and bought things that made me happy instead of put it in there because I want, I think I'm down like 50, not 50%, but I'm down a decent amount now. It's on the portfolio. You guys can go check it out. But I'm down a decent amount. And so I'll suffer with you guys, and I'll never sell it. Like I'll never sell it unless it goes up to the point where in which I'll start making these videos again, talking about these risks, and I'll take my profits and deploy it elsewhere. And I'll, you know, I don't know, I'll go to like Miami or something and enjoy myself with my wife or something. All right. On that note, guys, I hope you guys enjoyed the video. Go ahead and feel free to leave a like. If you're not subscribed, go ahead and subscribe, and then come back for, you know, different kinds of content. I usually do the subscriber request videos. Videos like this are the more conceptual videos. But again, yeah, just comment down below if you guys have any questions or you disagree or agree. All right, guys. Hope you guys have a great one. Thanks.